Hey everyone! Welcome back to the channel. If you're new here, don't forget to hit that subscribe button for more financial tips and strategies that'll help you grow your wealth and secure your financial future. Today, we're diving into a very important topic: long-term investment strategies. Whether you're just starting out or already have a portfolio, long-term investing can be a powerful way to build wealth and achieve financial freedom. We're not talking about get-rich-quick schemes here. This is about making smart, strategic decisions that will pay off over time. You see those Lambos driving around LA? Forget about them for now. This is about building something that lasts. So if you're ready to ditch the ramen noodles and start building a brighter financial future, stick around because we're about to break down some of the most effective long-term investment strategies out there. Let's get started. First things first, why long-term investing? You hear all this talk about the stock market, day trading, crypto, all that. It can be overwhelming, but the reality is, the stock market can be unpredictable in the short term. It's like trying to time the waves at the beach. You might catch a good one or you might get wiped out. But here's the thing, history shows that the market tends to grow over time. Think of it like a rising tide. Sure, there are waves, but the overall direction is up. By holding your investments for 5, 10, or even 20 years, you're more likely to ride out those market fluctuations and come out ahead. Remember 2008? The housing crisis? People who panicked and sold their investments locked in those losses. But those who held on? They saw the market recover and even surpass its previous highs. Patience is key, people. And there's another huge advantage to long-term investing: compound growth. This is where your money starts working for you like a beast. Essentially, the interest you earn on your investments starts earning its own interest. It's like a snowball effect, and it's one of the most powerful tools for building serious wealth. Think about it this way. Let's say you invest $10,000 and earn a 7% average annual return. After just 10 years, your investment would grow to almost $20,000. After 20 years, close to $40,000. And after 30 years, you'd be looking at over $75,000. That's the magic of compound growth. Now I know what you're thinking. But Graham, I'm young. I want to enjoy my money now. And listen, I get it. There's nothing wrong with enjoying your hard-earned cash. But I'm here to tell you that the sooner you start investing, the better. Time is your greatest asset when it comes to investing. The earlier you start, the more time your money has to grow. You might be surprised how much even small, consistent investments can add up over time. So, if you're serious about building wealth and securing your financial future, long-term investing is the way to go. It's not about getting rich quick, it's about making smart, strategic decisions that will pay off for years to come. Alright, so we've established that long-term investing is the way to go. Now let's talk about how to actually do it. And trust me, you don't need to be a Wall Street whiz to get started. One of the simplest and most effective ways to invest for the long haul is through index funds. These are like the superheroes of the investment world. Low cost, diversified, and they consistently deliver solid returns. So what exactly is an index fund? It's basically a basket of stocks that tracks a specific market index, like the S&P 500. The S&P 500 represents 500 of the largest companies in the US. So when you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all those companies. Think of it like a pizza. Instead of trying to pick out all the best toppings individually, you're getting a slice with a little bit of everything. It's a simple way to diversify your portfolio and reduce your risk. And here's the best part. Index funds are incredibly low cost. Because they're passively managed, meaning they simply track an index, they don't require a team of expensive analysts to pick stocks. This means lower fees for you, which can make a huge difference in your returns over time. I've said it before, and I'll say it again. Fees matter. Even small differences in fees can eat into your profits over the long run. Now you might be thinking, but Graham, wouldn't I make more money if I picked individual stocks myself? And sure, it's possible to beat the market by picking individual stocks. But it's also incredibly difficult, even for professional investors. In fact, studies have shown that the vast majority of actively managed mutual funds, which are run by professional stock pickers, fail to outperform the market over the long term. So, unless you're willing to put in the time and effort to become an expert stock picker, index funds are often the smarter choice. They're simple, they're low cost, and they've historically provided solid returns. What's not to love? If you're just starting out with investing, index funds are a fantastic place to begin building your portfolio. Dollar cost averaging, mastering the market roller coaster. All right, so you're ready to start investing in index funds. Great. But when's the best time to buy? Should you wait for the market to dip or just jump in right now? Well, here's the thing. Trying to time the market is incredibly difficult, even for seasoned investors. It's like trying to predict the weather. You might get it right sometimes, but you're bound to get rained on eventually. So, what's the solution? Dollar cost averaging. This strategy is like having a secret weapon against market volatility. It takes the guesswork out of investing and helps you build wealth steadily over time. Here's how it works. Instead of investing a lump sum of money all at once, you invest a fixed amount at regular intervals, regardless of what the market is doing. This could be monthly, quarterly, or even annually. Let's say you decide to invest $500 every month into an index fund. Some months, the market might be up, and you'll buy fewer shares. Other months, the market might be down, and you'll buy more shares. The beauty of dollar cost averaging is that it takes advantage of market fluctuations. When the market is down, you're buying more shares at a lower price, which lowers your average cost per share over time. And when the market eventually recovers, as it always has, you'll be in a great position to benefit from those gains. Think of it like buying gas for your car. Would you rather fill up your tank when gas prices are at their peak? Or would you prefer to buy a little bit each week, averaging out the cost over time? Dollar cost averaging is the same concept applied to investing. It's a disciplined approach that helps you stay invested, even when the market gets bumpy. It removes the emotion from your investment decisions and allows you to focus on the long-term goal-building wealth. So don't stress about trying to time the market perfectly. Embrace the power of dollar cost averaging and let it work its magic. Diversification. Don't put all your eggs in one basket. Okay, we've covered the importance of long-term investing, the power of index funds, and the magic of dollar cost averaging. Now, let's talk about another crucial aspect of building a solid investment portfolio: diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, the same principle applies to investing. Diversification is all about spreading your money across different asset classes to reduce your overall risk. Think of it like this. If you invest all your money in a single stock and that company goes bankrupt, you lose everything. But if you spread your investments across different stocks, bonds, real estate, and other asset classes, you're less likely to be wiped out by a single event. Now, there are different levels of diversification. Investing in multiple stocks within the same industry is a good start, but it's not enough. You want to diversify across different sectors, industries, and even geographies. For example, a well-diversified portfolio might include US stocks, index funds tracking the S&P 500, or the total stock market are a great foundation. International stocks. Investing in international markets can provide exposure to different economies and growth opportunities. Bonds are generally considered less risky than stocks and can provide stability to your portfolio. Real estate. This can include physical property, REITs, real estate investment trusts, or other real estate investments, other alternative assets. This category can include things like gold, commodities, or even cryptocurrencies. However, it's important to note that these investments can be more volatile and should be approached with caution. The specific allocation of your portfolio will depend on your individual risk tolerance, time horizon, and financial goals. A younger investor with a longer time horizon might choose to allocate more to stocks, while an older investor approaching retirement might opt for a more conservative approach with a higher allocation to bonds. The key takeaway here is that diversification is not about avoiding risk altogether. It's about managing risk effectively. By spreading your investments across different asset classes, you're creating a more resilient portfolio that can weather market storms and help you achieve your financial goals over the long term. So there you have it, folks. Long-term investing is one of the best ways to grow your wealth over time. By following these strategies, staying patient, and avoiding emotional decisions, you'll be well on your way to financial success. If you found this video helpful, be sure to give it a thumbs up, leave a comment below with your thoughts or questions, and don't forget to hit that subscribe button for more content like this. Also, click the bell icon to get notified every time we post new videos. Thanks for watching. Before we go, here's a quick disclaimer. This video is for informational purposes only and should not be considered financial advice. Always do your own research or consult with a financial advisor before making investment decisions, as all investments carry risks, and past performance is not indicative of future results.